Hello, I'm here with Paul Jenkins, who is a distinguished fellow at the Center for International Governance and Innovation, CIGI, our partner at INET, and he also used to be a Deputy Governor of the Bank of Canada. Paul, thank you for coming and agreeing to be interviewed by us today.
Delighted to be here, thank you.
Can you first of all tell us what you've been doing here the last few days other than enjoying the sights of Hong Kong?
Well, actually participating in the various sessions here at the INET plenary. Prior to the start of that, I was also involved in organizing a workshop. But one of the projects that we're doing with INET and collaborating with CIGI and Chatham House is on the internationalization of the RMB. So we organized a workshop that I thought was very, very helpful in getting an Asian perspective on these issues. So that, together with attending the sessions of the plenary, and of course it's a great opportunity for networking. So that's really been the main focus of my time here.
Now I know that I was also at that workshop, and
you were. I was waiting for you to say yes. It was very good.
And I know that we operate under Chatham House rules, so we can't really specifically discuss it. But I think it's fair to say that it was a fairly animated debate. It touched on a lot of hot button issues, the potential internationalization of the renminbi as a reserve currency, capital account convertibility, globalization. Do you want to just touch a little bit on those themes a little bit?
Well, this has been an area of interest that I've had for several years now. I was involved with a report that I co-authored with Chatham House on international policy cooperation, and one of the elements in that report was looking ahead over the next 5 to 10 years to what really is going to be a very different global economy with the emergence of China, but of course many other emerging market countries. And so from that perspective, one of the big issues in my mind for China, but for the world, is what I call the second wave. The first wave being China's accession to the WTO, and the next wave being their integration financially, which includes the issue of the internationalization of the RMB. So it's not just from the perspective of what that might mean for China, but what it means for the functioning of the international monetary system overall. So as you say, we had a very animated discussion, and for me, what I really wanted to do was hear the Asian perspective on these issues, which will help us formulate the project going forward.
One of the things that struck me, and it's not just from at that workshop, but because I've also spoken to people at the People's Bank of China myself, was that capital account liberalization still seems to be a given. That seems to be still part of the ultimate long-term roadmap. And I was a bit surprised about that, given that we had the Asian financial crisis, and of course China withstood the effects of that better than a lot of other economies, because it, in part, I think, because it didn't have full capital account convertibility. And then, of course, the great financial recession of 2008. And yet, these are just viewed as speed bumps rather than opportunities, perhaps, to reassess whether they should be heading, they're heading in the right direction.
I think they are heading in the right direction. I take it that when you think about the future growth of China and where that growth is going to come from, they've had a very successful growth model that has largely been driven by exports. And of course, related to that, in my view, has been their exchange rate regime. But it has led to costs for the Chinese in terms of the accumulation of reserves and how they've invested those reserves. And so when you look forward and you say, well, where's the growth going to come from? Given the scale and size of China, more of the growth has to come from domestic demand sources within China. And I think that is understood. I think that change in the growth model is recognized. And so for that to actually be effective, and we are looking out the medium term and longer, for that growth model to be effective, I think you need to liberalize the financial sector and to open up the capital account. And yes, there are tripwires along the way. Many people would point to those, but I think it is, in many respects, a prerequisite for them to do what they deem is necessary to grow and continue to prosper. And therefore, the question is, what are the policy frameworks that need to be put in place? What are the sorts of regulatory structures that will be required to make the financial sector work to the benefit of the Chinese? So it's not a simple task by any stretch, but I think it's the right direction. And so this report is designed to help define the discussion, conceptualize the issues, to help people think about it in a more coherent way in a sense, because it is very complex.
It's very complex, and of course, getting the financial sector to serve broader public purposes is an ongoing challenge, not just in China.
Challenge, yes, as we've seen over the last 5 years, definitely.
So,
but you don't want to draw the wrong lessons from that.
No, absolutely, absolutely. And you, of course, probably being a former central banker at the Bank of Canada, it's interesting that all of a sudden Canada has now become the hot and trendy flavor of the month for good reasons, I would say. The country withstood the crisis better than most other countries, and maybe it was because Canada has in effect adopted the correct regulatory framework.
I think that's a big part of it, not the only part, but I mean, Canada has had its problems over the years. We had 2 bank failures back in the 1980s. They were small, but out of that we put in place a new regulatory structure which remains in place today. And so there were 3 or 4 distinctive differences between what was happening on the regulatory side in Canada going into 2008 compared to many other jurisdictions. So, for example, a tradition of having higher levels of capital and a higher quality of capital within the banking system. Actual leverage caps, so the Canadian banks didn't get into that exuberant growth of debt and leverage that you saw in many, many other jurisdictions. So there were a number of elements to the Canadian policy framework, regulatory structure.
And institutionally as well, because of course the other advantage that you have in Canada is that the regulatory environment is broadly speaking conducted under one regulatory framework, whereas in the US, you know, you've got the CFTC, the SEC, the OCC, so there's a scope for regulatory arbitrage.
Right. Yeah, that's correct, but a nuance. Yes, we have a single regulator for financial institutions, the Superintendent of Financial Institutions, but we also have mechanisms to bring other agencies that are involved in the regulatory process together. That would include the Canadian Deposit Insurance Corporation, Department of Finance, Bank of Canada's lender of last resort. So a recognition that when you get into regulatory issues, you actually need all the agencies that have a role to play working together, and this ability to bring these organizations and agencies together works very effectively in Canada. But of course, having said all that, Canada was caught up in the global recession quite intimately, in the sense that the liquidity constraints that we saw in global financial markets spilled over into Canada quite directly. In terms of the real economy, the big impact was on our trade sector, where our exports declined something in the order of 30 to 40% in real terms. You know, Canada exports doors, windows, lumber, cars to the United States, those areas that were most affected in the United States by the implosion of the financial sector there. So we are still working our way through the consequences of the global financial crises in terms of economic growth and the fallout implications of that.
My understanding as well that there is some talk now in Canada about a property bubble. You know, we didn't experience that in the late 2000s the way they did in the United States. My sense, however, is that this is more of a classic boom bust in terms of the you know, prices have gone up and there's an affordability issue, and maybe there's a concern about debts relative to incomes. You know, these are traditional factors, but it doesn't seem to me to have the same kind of systemic risks that you had in the US, because my sense, and you can enlighten us on this, is that the funding mechanisms used to drive, which have driven real estate, are not as toxic in Canada as they were in the United States. We didn't have the CDOs, for example.
Right. Yeah. I mean, securitization is a very, very small part of the Canadian financial structure, in contrast to what happened through the subprime mortgage market in the United States. We have had some upward pressure on real estate properties, primarily in Vancouver and Toronto. The average rate of increase of house prices up until the last, say, 12 months was in the order of 2 to 3%. That has come off. So yes, there hasn't been the same, you know, toxic mix, if you like, that you saw in the United States. The issue of debt levels is clearly related to that, but it's also related to the fact that with the decline in our traded goods sector of the real economy, to promote economic growth, the macroeconomic policy frameworks responded in terms of lower interest rates. The Bank of Canada overnight rate is at 1%. It was at a low of 0.25%. So there was an encouragement through macro policy to sustain economic growth through domestic demand, primarily through consumption and housing. That has worked and worked fairly well, but one of the consequences of that has been a rising consumer debt level. And so what we've seen in Canada, the authorities, Department of Finance, Bank of Canada has been talking about this, is the need to be cautious so that those debt levels don't get to a point where that they too become a potential systemic risk. And so Canada has actually taken measures to adjust what you would call macroeconomic policies, sorry, macro-prudential policies, adjusting loan-to-value ratios, amortization to provide some focus on the mortgage market itself as opposed to raising interest rates that would affect the whole economy.
And clearly the rest of the world has taken note because even though it's one of the smaller economies in the G8, it's perceived to be a country that punches above its weight, certainly as far as international economic diplomacy goes. When Mark Carney speaks, people listen, and of course now he's on the way to become governor of the Bank of England.
That's right, that's right. Well, Canada has always taken a very active role internationally because we are an open economy, and we've produced some world-class international economists over the years, but I think the essence of it is Canada is affected by what goes on around us, and so we have always played a very active role at that international table, and as you say, Mark Carney's position has been highly regarded and respected, and moving on to the Bank of England.
And he, of course, has been in the vanguard of moving away from pure inflation targeting. He suggested some other measurements that ought to be used to take into account the conduct of monetary policy, such as nominal GDP targeting as an example. I mean, what are your thoughts about that?
Yeah, I think the way you've just expressed it, I think, is an overstatement. Governor Carney has been on the record and quite recently to continue to promote inflation targeting as an important policy framework. The issue of nominal income targeting has certainly been raised, but from a technical point of view, the issue that was raised was nominal income level targeting, which is comparable in many respects to price level targeting, which is different from inflation targeting. And we could get into some of the technical differences, but when Governor Carney raised it in one of his speeches dealing with the whole issue of guidance in policy, which is very, very important, the issue of nominal GDP level targeting has certain implications for expectations, as does price level targeting. So these are important discussions and debates to have, but I would just note that the UK budget that just came out recently, there was an annex in terms of the remit of the Bank of England, and there were some changes made to that, but the core element of inflation targeting remained very much in place. The adjustments, as I would interpret it, were in the context of providing the Bank of England with more scope to provide this guidance in terms of future interest rate movements. And as well, the important issue of how to think about and coordinate as required monetary policy and this macro-prudential policy, which is directed to financial stability. So there are a lot of new important areas to think about, but in the context of inflation targeting as a core component to the remit of central banks.
So essentially it's not just taking one tool and putting another one back, but increasing the number of tools in the toolbox.
Exactly. I think that's a very good way of putting it. And the critical element there that you've really hit on the head is having the right tool to deal with the right problem.
And so far, so good in Canada anyway, and hopefully Mr. Carney can continue his success in the UK. We're going to leave it there, but again, I want to thank you for sharing your insights. It's great to have you here, and it's great to have CG as one of our key partners in going
well,
forward.
From a CG perspective, it's been a great partnership, and we look forward to continuing that. So thank you.
All right, thanks a lot.